Hey guys, Adam Rose, Vice President and Senior Loan Officer for Western Ohio Mortgage here in Sydney, Ohio. Today is another episode of the Mortgage Guy Podcast. Today we want to talk about owning versus renting, and I kind of did a 10-year reality check, we'll call it, on what this looks like over what I would consider a short run, right? Not the 30-year run, not the 20-year run, or 40 or 50 or whatever it is. Just a 10-year look, right? Because you know, a lot of people think of owning a home as a moral decision. It's not a moral decision. It is truly a financial decision, and it's a financial investment. And I want you to think of it that way when trying to figure out, is now a good time to buy? Is then a good timing the market isn't nearly as important as time in the market when it's a financial decision. I want you to think of that. Okay, might sound weird. Try to wrap your brain around that one. Anyways, you know, most people do believe that renting is cheaper because the monthly payment can be lower, of course. But over that 10-year period of time, renting can be the most expensive housing decision a consumer could possibly make in regards to the loss of equity and what they're gaining for their dollar. And this is going to kind of reframe that look of, you know, housing as cash flow on the long term and the wealth building side more than anything. So I will take a look at some of my notes because I did write down a bunch of numbers to get this kind of ready. Now, again, this scenario isn't perfect. Okay, I didn't spend 12 hours trying to figure out all the exact details. This is going to be broad brushstroked, but it should be pretty darn close. Okay, so let's start with the renting example over a 10-year period of time. Okay, now we know rents are all over the map. Depends on what you're renting. Is it single family? Is it multifamily home? Is it, you know, what market are you in and stuff like that. Okay, so bear with me on these numbers. And I might be low if you're in a bigger market like a Columbus or a Cincinnati or Dayton. This may be way too low. Okay, so let's just start with a market rent, $1,500 a month. Okay, so this is obviously assuming a single family home that you're renting. Most likely, unless, like I said, you're in a bigger market. And we're going to assume an annual rent increase of 3%. Okay? Somewhat conservative. Some people lock it in. Sometimes there's obviously annual increases, which a lot of people have experienced in this market. So total rent paid over a 10-year period of time, approximately, okay, taking into account a 3% increase every year, is $206,000 over that 10-year period of time. Now, how much equity did you build? Nil, right? So in year 10, your rent's going to be approximately $1,960 per month. Okay, so rent is 100% interest. Every payment is leaving your bank account permanently, right? Now, again, positives of renting, you don't have any you'll have some responsibility, of course, but typically speaking, any major repair issues or something like that, we're just assuming nothing happens, okay? No repair issues, no anything like that, because obviously that is a decision that you have to make. Quality of home plays a role. If it's a little bit newer, you know, your mechanicals typically are going to last more than 10 years, but again, they can go out sooner than that. So let's just take that out of the equation because that's a lot of unknowns, right? A ton of unknowns. So you can't really do a side-by-side comparison using unknown factors that aren't guaranteed to happen. Okay, so let's do the owning scenario. Now, for this, I did only principal and interest. Okay, so and I also have the amount paid over the life of that 10 years, assuming some escrow, like insurance, taxes, stuff like that. So, quick example: $300,000 purchase price. Okay, let's call it a conventional loan. Let's say 5% down, $15,000. Okay, loan amount's $285,000. Let's use not even an aggressive rate, 6.5%. Okay, and then with that, your principal and interest is approximately $1,800 a month. So the total you're going to pay over that 10-year period of time is $216,000. Okay, so if we assume $300 a month for escrows like insurance, taxes, stuff like that, it's closer to about $250 is what you're going to pay over that 10-year period of time, compared to you paid $206 for the rent. Okay, so a little bit more out of pocket, of course. Now, after that 10 years of ownership, here's where the key on the cash flow piece comes into play. Is you've paid down enough, and again, if you're doing a 30-year mortgage or something like that, it's not going to be as much equity as you would hope after spending, $200 and some odd $1,000. However, just paying down the loan balance, you're going to have $45,000 to $50,000 of equity that you've created during that time, okay? Give or take a few bucks. Now, let's also assume that your home is going to appreciate in value. Now, again, market stability plays a major role, kind of an unknown factor, but going on with the concept of 3% annual increase in rent, 3% annual appreciation, which, by the way, from 2019 to 2025, it was significantly more. But again, keeping your home up to date, making sure you're keeping it in good shape, clean, stuff like that. Let's assume 3% annual appreciation. So that's approximately $103,000, okay? $103,000. Plus, you've got about $50,000 that you've paid down on your loan balance. So over that 10-year period of time, it's approximately $150,000 equity position, okay? $150,000 equity position. And now take that into account that if we paid escrow, you spent about $250,000, right? Versus renting, you spent $206,000. Showing nothing on your $206,000, but on your $250,000, you've got about $150,000 in equity possibly. All right. So this can be quite a tool to use in regards to home ownership. Like I said, it's not about market timing necessarily, even though we all want the perfect rate. We all want the perfect price point because prices are a little ridiculous, of course. But nonetheless, rent is comparable in regards to the market for owning. As you've seen since COVID started, rents got crazy. So have home prices for buying and stuff like that. So it is comparable in regards to the cost going up. Hopefully that information was helpful, guys. Remember, subscribe on YouTube. Check us out on Apple Podcasts, Spotify, and we'll catch you all